Som Sundaram, PR, MD, World Gold Council, India. Atul Singh, MD and CEO, Julius Baer, India. Vineet Arora, Executive VP, ICICI Securities Limited. And Munish Randev, CIO, Waterfield Advisors Private Limited.
All right, good afternoon, everyone. We've had many panels through the day, and we've discussed cash flows, cash flow management. We've discussed insurance. We've discussed equity and long-term investments in equity and debt. But really, Indians traditionally use real estate and gold. Traditionally, that takes care of everything for Indian households, be it your long-term investment, be it your cash flow, be it your old age insurance in a sense. So this panel will really focus on those assets and of course alternate assets as well, because really times are changing and there was a lot of discussion on asset allocation. And what we've seen in real assets, real estate and gold happening in the last few years, the whole some of that thinking is changing, the traditional thinking, and a focus on asset allocation is happening. So this panel, we're going to keep it very tight because some of our panelists do need to move on and we're running late. So we'll dive right in with real estate, where, the last, I think, 2-3 years, a little bit more than that, has been really not a good period. We've seen residential real estate, particularly where prices, demand, everything is falling. And demonetization, of course, was the knockout punch, really, for whether it's launches or even sales in this space. But Ramesh, let me ask you: do you think that that we've seen the bottom somehow, and that maybe there is some value, because in the last 3 months post demonetization, a lot of that value got knocked off in one go? So do you think that there is maybe a sense that a bottom is forming in the residential space? And there could be some value buys, some kind of distressed sales from investors that one can look at?
Lisa, I used to always wonder when I used to watch these financial news channels, why do these stock market gurus always end up bashing the real estate sector?
Right.
It took me a while to figure out that among what Indians save, just around $5-6 billion actually goes into the stock markets and mutual fund market every year. While around $160 billion every year goes into the real estate market. So obviously even a $1 billion coming from the real estate market into the stock markets would have meant for the stock markets a 20% growth. So there's always a lot of negativity around the real estate markets, obviously because the entire financial media is biased towards stock markets. Last 2 years, definitely not been good for the residential sector. What we have seen is price increase of just 3% and 1.5%. Even in the worst of these times, prices actually haven't gone down. But what we are also seeing is, okay, on the residential asset class, we have seen huge amount of inventory pile up. But commercial demand, since Moody's taken over 2.5 years back, has actually gone up more than 50%. Retail demand has gone up, industrial demand has gone up. So again, it depends from asset class to asset class. But the good news for the residential sector again is in the last 8 quarters, the launches have consistently gone down. So, and in the last 4 quarters, what we have seen is the demand, which is the sale, is actually more than the launches. So the self-correction phase has already started.
In commercial space?
I'm talking residential. The demand has actually been less than the launches. So the developers have reduced their launches. They're phasing out their projects. They've reduced their sizes. The government is doing a lot on the tax part, at least, to encourage affordable housing. So what you said is exactly right. The market has bottomed out. We believe there will be pain again for this year. But towards the end of this year, you will start seeing the markets revive.
Right. Let me come to one of our advisors on the panel. Atul, maybe with you I'll start. So are you seeing demand from individuals on the residential side? And Ramesh mentioned about commercial. So there the yields are attractive. So is that an opportunity one can look at?
Yeah, I mean, on the residential side or broadly, first on the real estate asset allocation, I agree with Ramesh that, for high net worth individuals, I mean, for the country, the asset allocation for the wealth the country holds, 50% is in real estate, and rest 50% is divided into everything else, including bank deposits and financial assets, etc. And for our clients, the HNIs and ultra HNIs, the asset allocation has even been more skewed. So, 70, 80% of their wealth traditionally has been sitting in real estate. And, but the trend is definitely reversing towards more financial assets. So last 2, 3 years, we have seen at least the incremental flow first getting stopped in real estate and some of that flow spilling over to financial assets. And the trend has, I mean, I have not seen that trend slowing down.
Right.
And a lot of it you could see in the mutual fund sort of domestic flows coming back as well. So that clearly is a trend that financial markets are the recipient of that asset allocation shift that is taking place. So between residential and commercial, clearly residential demand remains very lukewarm amongst the investors. But commercial indeed is picking up. Smart investors are looking for higher yield opportunities, especially in the context of the broader yields going down in the marketplace. So 8, 9, 10% commercial properties, and investors are getting a bit of confidence that the bottom has been reached. So last 4, 5, 6 years have been terrible for commercial markets, commercial real estate, but we see that kind of trend reversing, and hence smart investors are definitely looking for deals there.
Munish, I'll come to you. And, we're talking about commercial real estate yields, but in the absence of any REIT-like launches, while for the HNI, the access could be there to commercial investments. For the mass affluent, really, there isn't much access. And, as yet, the residential bottom may not be as solid. So what does one do? Does one keep shifting, like Atul was saying, away from the physical to the financial assets? Because that trend has picked up in the last year.
Yes, it has, Lisa, and you're right. The retail and the lower part of the mass affluent didn't have any access to creating a portfolio of sorts in real estate. The reason was the ticket sizes and all the problems which come along with investing in real estate. What we have seen is that, and what we will see in the going forward is that any kind of aggregators, which are either REITs, any kind of funds, and tomorrow there may be 10 different kind of vehicles being created. They will form the solution part for access to real estate. Ultra high net worth will continue to love owning physical real estate rather than going into a fund. So retail people will have to guide it towards that. But as far as residential versus the corporate real estate is concerned, I mean, our view has been very different. For us, a bond is akin to a corporate real estate. I mean, you're getting some yield coming out of it. So rather than just owning bonds in your portfolio, do you really want to hold a real estate commercial asset? You're getting that 8, 9, 10% with some form of tax advantage on the rental coming in. And if you do your homework a bit, a bit of a homework, I think you can still control your capital values, or you can take a guesstimate of a capital values going forward. So for retail, they will have to rely with some managers to take that call for them, and specifically for the commercial part of it, because yields in the commercial space, net of fees, I don't know how many people understand, but the returns coming from a commercial real estate fund will be from the rental plus some capital depreciation.
Yeah.
So capital depreciation is not known today. It may be actually capital depreciation for sorts. So you need to be cognizant that the yields net of tax may not be that attractive. So the person may always take a view that, why can't I invest into an XYZ tax-free bond or an XYZ fund and get a post-tax of 7 or 6 akin to invest my money in real estate? Because inherently, even in the retail side, the real estate was predominantly for shelter. It was not for investment. They couldn't afford a second and a third and a fourth house for investments. So I think the jury will still be out about what attractiveness will be on a post-tax net of fee basis kind of returns for these investors. Ultra high net worth will continue to buy, and as Ramesh was mentioning, commercial real estate, they will continue to buy that because it's very attractive yield of 9-odd%. And if you can just do your market positioning and segmentation right, I think you can easily make another 5% is a natural accretion that you take in rentals, assuming a same amount of capital appreciation happening, plus some amount of market re-rating, you can easily make 12, 13, 14%. So I think that's what
Yeah.
gonna
Yeah.
be in the next 5 to 10 years.
Ramesh, what about REITs? Are we going to see that in FY18?
So, couple of private equity funds are in the final stages of working on their REIT structures.
Right.
The opportunity is quite huge. Our research showed that out of the 470 million square feet of office space which is there in the country today, around 250, 260 million square feet is REITable.
Right.
And even if half of that gets REITed, at an average rental of around 70 rupees with a cap rate of around 8%. That's a market of around $18 billion which can open up. So two funds likely that it should happen this year.
Yeah.
Should have happened last year, but two of them are actively looking at launching their REITs this
So
year.
some traction there maybe
There is.
for the smaller investor.
Definitely,
That will
definitely.
help. So let's come to gold now. The story hasn't been much different. I think from 2013, we had, I think, 2-3 years of very bad phase. And last year, the data is interesting because, so you know this, that a lot of that ETF, global ETF demand, which went out of gold, has returned with somewhat of a bang, really. So what's driving that?
It's, as you know, ETF industry is primarily Western. India is just under $1 billion.
Right.
And last year was the highest since Lehman collapse. Soon
Right.
after Lehman collapse, we saw some 700 tons flowing in. Last year, we saw 600 tons flowing into the ETFs in US alone, actually, not again talking of Europe. So it's primarily to do with all the, global issues, Brexit and elections and all those uncertainties, apart from the fact that, people, even the long-term investors, started believing that, look, this level of uncertainty can only be hedged through gold. So that was one of the primary reasons. And despite price falling and the markets doing better now, we haven't seen much of outflow even
Right.
now. So we believe that it is there to stay. It's a more strategic shift in the investment allocation. Primarily on India, China, Asia, it's a physical market. So
Yeah,
people
yeah.
continue to buy a lot of jewelry. And particularly China, they bought a lot of coins. So
Yeah.
it is there to stay because, the buying habits are very different from West and the East.
So is it a signal that maybe price has bottomed out as well, the international price of gold?
It's a very difficult thing. As you know, we don't comment about prices, but
Right.
if you were to look at it, very interesting data I had, the international price had gone up 8%, the LBMA price, since the beginning of the year.
Right.
Indian price has just gone up by 2%. Suddenly, rupee has strengthened. So when you talk of price, particularly for Indians, obviously you have to talk about the rupee price. And we did an analysis recently. We have invested as Indians, last 15 years, the CAGR of investment in gold has been 14%. 14% CAGR year on year for 15 full years.
Right.
So I think the expectation of people is that the prices will continue to rise, short-term changes notwithstanding.
So Indian gold is an interesting market, and maybe Munish, you can come in here a little bit. There is very little distinction when it comes to jewelry versus investment in India, and maybe some of that is changing, or maybe it's more policy-driven now. But nevertheless, the price hence remains really due to policy, maybe at an elevated level, throughout, whereas the global prices fell for a longer period, maybe. But people are showing some kind of price sensitivity. And in this kind of an environment where policy really is pushing you towards, away from gold rather, how does a mass affluent investor, is there merit in adding gold to asset allocation?
So Lisa, this asset class is the hidden asset class in many families. You may be a mass affluent or a retail or a ultra high net worth that we manage. For a primary reason, this is usually the decisions of jewelry are done by the women. And when we actually interact with many of the clients in mass affluent or
Right.
ultra high net worth, the financial decisions are construed to be men. Many a times we have had 6 rounds of discussions with our clients where only in the 6th round the jewelry holding came out. And the last it was valued was 2005. So, we have to go through the whole valuation process of understanding how much of allocation you have in gold today. And frankly, many times they are themselves surprised that you have 5% of my wealth allocation into gold.
Right.
So that's one problem that we have faced. I think secondly, jewelry versus not jewelry, let me put everything besides that. The making charges is the reason for the tracking error as far as prices of gold are concerned.
Right.
Many people are now understanding that with the push towards, say, the sovereign gold funds and gold bond schemes and all the stuff, you're getting some revenue coming in, some tax advantages do coming in, but that was primarily done by the government for a different reason. Not because of promoting gold, because of not promoting physical purchases and those kind of gold. So I think for a mass affluent person, he needs to see how much of gold automatically he has in the family and do it truthfully, because after demonetization, suddenly women find a lot of cash stuck in nook and corners. Gold has to happen that way as well. And secondly, take a call on, do you want to keep a jewelry, because jewelry doesn't, the style doesn't last 5 years or 6 years. So you can't give jewelry to your daughter after 10 years because it will be not out of style. So better to take in vehicles and instruments which can actually give you the upside of gold to hedge that price. But as far as allocation in the broader allocation is concerned, I think still the allocation is very low compared to others, because it's a reduced price, as Children was saying, that because rupee dollar has a lot of impact on it.
Yes.
And internationally, when the US interest rates go up, usually the gold prices come down. So we are in that stage. So we have to be cognizant of a lot of factors which mass affluent people generally don't understand to that extent a lot.
Okay. So that brings us to, you were talking about different products and vehicles. So that brings us to gold bonds. And Vineet, on your platform at ICICI Direct, you do have digital access to gold bonds. And can you tell us a little bit about where the demand is coming from? Is it from investors who own gold and who are kind of, looking at this as an alternative as well, or new investors who are saying, look, I'm getting interest as well, so, this is a good investment per se?
So I think it's a bit of both, but most of the demand initially has been people who were holding gold in electronic form already. So let's say ETFs. So they would have switched from ETF to a sovereign gold bond because this gives you interest also, it gives you some tax benefits also. So it's a obvious choice that, if I'm holding a gold ETF, then switch to gold bond whenever you get an opportunity. So a lot of money came in from that. And then gradually, I think with the interest starting to kick in and people getting a little more comfortable with a long-term view on gold. So they are buying some bit of allocation also and keeping. So these are people who are just making a portfolio allocation to sovereign gold bond, not just about, holding physical, converting. No. So I think physical has its own space and will remain like that in India. But our portfolio allocation towards gold bonds as a form of holding towards, when I look at my portfolio, I think that's where it's coming in. What I would, second with Manish is that, there's so much of gold which lies in households.
Right.
I don't think households are comfortable looking at that as part of portfolio allocation. So that's the real reason why, they would say, okay, if it's electronic, I can look at it as portfolio allocation. As long as it's physical, I don't consider that as part of portfolio allocation, especially when it's lying as jewelry and, things like that.
And as more tranches, as subsequent tranches keep coming, do you see the demand increasing as well, as in the subscriptions?
Yeah, so the demands have now stabilized to a very good level. I would say, every tranche typically ends up getting around 800,000, 1,200 kind of numbers. And when they started off in the beginning, it was some 200, 400 crore kind of numbers. So it's stabilized at that level. So it's not really gone up after that. But I think we get a lot of repeat customers. We get a lot of clients who just come in for this particular asset class and nothing else.
Right.
So there are clients who are only focused on just saying let me just pick up some gold, and they don't really go and invest in equities or something else also. So there's a varied class of assets which are coming in. Will this go up? Also depends on how the asset really provides us returns, what comes in. There is always an angle in gold bonds about liquidity because it's a different series, so it's not very liquid.
Right.
So if you are trying to redeem in between, you might not get the best price if you're trying to do that in between. But if you're holding to maturity, I think it's a great way to invest.
But the interest is increasing, and I think that paperless gold, it's a question I want to pose to you, Som, is about the push towards paperless gold, and that really means that you're not going to buy physical gold. And we're already seeing a drop in jewelry demand in India and China as well. So what does that mean for price? If people are not going to want physical gold, will that have an impact on price? Because the whole supply game then changes, right?
Yeah. Certainly, for the one part of the question, if India and China, the demand comes down, global price will be affected. That's absolutely given. I mean,
Right.
the entire support base is this demand. There's no doubt. But the next part of the question is, will these paper gold, like sovereign bond, this is the only paper gold, which is not backed by gold. If
Right.
it is backed by gold, it's a different thing. You're just
Exactly.
institutionally keeping it.
Yes.
Will that actually bring down demand in a significant way? You should know, ultimately, if you aggregate the figures, even the government said we will issue $2 billion worth, 14,000 crores worth
Okay.
of bonds. I don't think they have even touched that much. $2 billion, we buy $35 billion every year. So it's not a great, it's not going to make a big dent. Yes, at times like this, when already jewelry demand is low, it might affect. But in a long, if you take 2-3 years, $2 billion is nothing. It's probably Chandni Chowk sale on a particular day.
Right, right.
So, question is, will paper gold really bring down demand and therefore price? It's very difficult because if you can create paper gold, okay, with just this, and somebody has to take the price risk, then every government will do it. Therefore, we believe there is a space for such investments, but they are not going to be so significant that they will affect the physical demand.
Okay. So moving on and coming to a few more alternate assets, and here we will discuss, the fund space, the alternate investment funds, and really the category 2 in India is one where a lot of assets got collected last year, and the likes of PE funds, real estate funds, etc. So Atul, maybe we can begin with you here, and tell us a little bit about where the demand is coming from. Is it just pure diversification? Because HNIs look at this category a lot now.
Sure. And so in alternatives, which is, by definition outside of core holdings of equity and bond,
Right.
the traditional options were real estate and gold, commodities, but broadly gold. And now this space is kind of getting populated with other options. So the two, I would add to AIF funds, I would add to one other asset class, which I'll briefly speak about,
Right.
which is offshore. So, with the liberalized remittance scheme of RBI of sending $250,000 out and ability for a family to sort of pool the allowances for kids and parents, it's a viable option to really put assets that are uncorrelated to Indian equity or bond market. So truly qualifies for alternatives. And so there the clients are looking for diversification. That's the real diversification on the currency. So, Indian rupee will continue to be a depreciating bias currency because of the natural difference in inflation growth versus the US inflation growth. So, and a lot of families, kids are going, abroad for education at some point, the travel is abroad. So, so clients do want to keep some assets which are non-correlated to Indian rupee. So that's the driver for keeping some money in offshore. Coming to the funds, AIF space, alternative investments fund space definitely has seen a lot of traction. I would say probably beginning in 2013, 300, 400 crores category has now become about 30,000 crores.
Yeah.
Between AIF category 2 and category 3. So category 2 is, the PE, the private equity, also real estate investments, so both in the debt and equity. So, giving money to developers, taking it as debt or investing in real estate projects and delivering the returns there. And AIF 3 is more in the listed market, so more hedge fund-like structure. So a lot of long short, using a lot of derivatives, etc. And both the categories, I would say, have seen tremendous growth. So, 30, 40% growth rate year on year.
What's the return expectation though? Because, real estate funds in particular, because we have some history of a cycle going through in those funds,
Yeah.
we haven't seen any great returns happening. In fact, people have lost money.
Yeah.
So is it really worth taking that, risk over a simple equity mutual fund, for example?
Yeah. So again, Lisa, I would say whenever we look at AIF, you have to differentiate between category 2 and category 3.
Okay.
So category 3 which invests in public markets, more hedge fund-like structure,
Right.
serves a very different purpose. So now the purpose that serves is giving you a more absolute return. So it is market independent return, right? So while they invest in markets, but the cash calls that they take, the use of derivatives, etc., they promise a steady sort of linear return, irrespective of where the market goes.
Right.
So if the market is down 5%, it's not acceptable to deliver -2
Right.
and feel good about it. I mean, you still have to deliver positive returns. So there, the return expectation is, so that category actually sits between pure equity markets and debt. So, maybe 12, 13, 14% linear accrual by those long short / hedge fund type strategies have been very popular, right? And they're not tax efficient, so that's why they have to run harder to really deliver a good post-tax return. But that's where they are. I mean, between debt and pure equity. The AIF category 2, which is real estate mostly, have been on the real estate side. The first phase of those funds were a lot of equity investing, right? So
Yes.
all the managers took development risk along with the developers, and that didn't really pan out very well because developers ran into various kind of issues, and so while if you had bought a flat or an apartment yourself as an investor, you would have made a lot of money. But coming in through these funds, the experience was not great. I mean, there were governance issues, etc., as well, and controlling the developer was very hard. Now, so you're absolutely right. The experience was not great. I mean, these were long-dated funds, and there was no liquidity, no exit, and in the end, the return expectations were not met. Now, of course, that focus has shifted to more debt and mezzanine debt type instruments. So.
Right.
The same managers have shifted to giving money to the developers and having